Why does regulatory arbitrage persist despite Basel Accords? Imagine a world where rules are meant to keep everyone safe, but some players find ways to bend or skip them. That's what happens with regulatory arbitrage, even after the Basel Accords. These accords were created to make banking safer worldwide by setting minimum capital requirements and risk controls. But the truth is, they don't cover everything. Different countries interpret and enforce these rules in their own ways, which leaves gaps. Banks and financial firms can take advantage of these gaps by moving activities to places with looser rules. Regulatory arbitrage happens when companies find ways to reduce costs or avoid strict regulations by shifting their operations across borders. For example, a financial product might be heavily regulated in one country but lightly regulated, or not at all, in another. Firms can set up subsidiaries or move transactions to jurisdictions where compliance is cheaper or easier. This way, they keep more profits while sidestepping tougher rules. One reason it keeps happening is that countries have different capacities and priorities. Some nations may delay or only partially adopt Basel standards, creating uneven rules. Financial innovation also plays a role. New products and structures are constantly being developed that don't fit neatly into existing Basel rules. This makes it hard for regulators to keep up and close loopholes. Another factor is the rise of non-bank financial entities like hedge funds and offshore companies. These groups often face lighter regulation than traditional banks. They can offer similar services without needing to hold the same amount of capital, which makes regulatory arbitrage easier. Globalization makes it even simpler for firms to move money and activities across borders. They can choose the most favorable regulatory environment, a practice known as jurisdiction shopping. But enforcing rules across different countries is tough. Legal systems, supervisory resources, and political will vary, making international cooperation difficult. Looking at financial history, this pattern isn't new. Whenever regulations tighten, new ways to get around them emerge. The Basel Accords marked a big step toward more stable banking, but history shows that financial firms are always looking for ways to exploit gaps. This ongoing cycle can weaken the goals of Basel because risks can build up outside the regulated banking sector. Regulators are aware of this challenge. They are working to improve international cooperation, increase transparency, and include shadow banking and complex financial instruments in their oversight. Still, the persistent nature of regulatory arbitrage shows how tricky it is to create a truly uniform global financial system. As markets evolve and new financial tools emerge, the game of regulatory catch-up continues.